Hey everybody, thanks for joining us today on this Monday morning here on what is going to be a tough day. And really wanted to bring with you two key themes here and three perspectives, if you will. The two key themes are that firstly, panicking has not necessarily made anybody any money over time, and number two, that your time frame really matters. And from that perspective, we wanted to bring you today three different perspectives. Firstly, a trader's perspective, secondly, a fund manager's perspective, and third, an individual's perspective. Now, before we get into it, we just want to say that this advice today is all general in nature. It does not take into account any of your specific circumstances. And with that, Shaun, my business partner, it's ugly out there. What are you seeing?
Hi, everyone, and thanks for joining us today. It's even harder than what we thought because the US futures are down 3.5% currently. They were down about 5% before, so there's a lot of volatility around and a lot of selling. Look, we've gone through this quite a few times. I would say that this is a event that happens every 3 to 5 years where you get something like this, and the last was COVID. So the 180 Markets website is very quiet. No placements today as expected, and I don't think there will be any for a while. Capital raisings, as we saw after COVID, there just weren't any, and I think something that'll show us that when the market is bottoming, there will be a lot more raises. And something I remember well from post-COVID days is the raises were done at very cheap prices. So we're going to hang around for that, and hopefully we'll get some good opportunities soon. But yeah, a lot of selling on screen today.
Right, great. And with that, I guess in no particular order, and obviously there'll be time for a Q&A as well, we wanted to bring in a fund manager's perspective. And Richard, Gavin, maybe for starters, just tell us at Orsaro, what is your overall strategy, just to bring, there are a lot of people on the call who are not necessarily familiar with you, and just to bring your perspective, if you will.
Hi, Greg. Thanks for inviting us to the webinar. So Orsaro Capital runs the Orsaro Global Fund, and our focus is on long-term investing in global equities. We're predominantly invested in the US, and really for us, it's about having an ultra-long time frame, owning great companies led by great management, trying to shut out the noise like what we're experiencing now, and investing in these companies for the long term.
Right. And let me ask you, following on from that, obviously it's tough to fight out, seeing a market down circa 10% in 2 days' time. From a portfolio construction point of view, are you looking at it as an opportunity to either add to your favorite names, to rejigger their portfolio, or to frankly just do nothing?
So good question. I mean, we're in quite a fortunate position that, we started feeling early on in the year that the market was very expensive. And we started, taking the approach of trimming some of our positions that we felt were starting to get quite overvalued. In some extreme circumstances, we even exited some positions. So, during the first quarter of the year, we had a cash balance as high as about 18% in the fund. And as the market's been falling, we've just been slowly deploying those funds. So we're not going and just investing everything at once. This market's fallen, dramatically. We're now in a bear market, as Shaun was saying, with the futures down. The S&P 500 is down over 20%. So we're really deploying, funds slowly. And how are we deploying those funds? Number one, we're looking at our existing companies that we hold, and those where we think the internal rates of return are really high at these lower levels. We're continuing to invest in those. But we've also got companies on our watch list where we would have liked to own the companies. We felt valuations were too high, and those companies are really now getting back into our target valuation range, but not doing nothing. I mean, we get a little bit excited. It's a bit scary to say. It's a scary market, but fortunately, you got cash. It's quite exciting because you can start deploying that cash at much lower prices.
Right. And I'm curious your thoughts, the Magnificent Seven, which has been such a source of outperformance over the last 3 or 4 years. But as you said, those stocks were very, very expensive. In fact, we saw the biggest de-risking out of any in March, I believe in the last 10 years from hedge funds. do you look at those names now as potentially coming into your buy zone?
Greg, it's a good question. So maybe we could just take a step back, because
Yeah.
the way we do things is we try and model what kind of return we think we can get from companies. So we model the earnings over a 10-year period. Obviously, it's a best guess. I mean, no one knows. And then, we act accordingly. So towards the back end of last year, we felt that the Magnificent Seven really was crowding out the rest of the S&P or the rest of the market. So when you looked at that valuation, the valuations looked extreme relative to the S&P 493. We thought with rate cuts, with the new administration, that the equity performance would broaden out to that wider S&P 493. So we started trimming a lot of those names already, like Alphabet, even like a Microsoft. Great companies, great growth companies for the long term, but where the valuations were extended. Now, can tariffs, cause these companies to fall further? Of course they can, because obviously these are not directly impacted. I mean, Microsoft or Alphabet, they don't import anything from Asia where you're going to get a 50% tariff, but a global growth slowdown, is going to cause issues for everyone. I mean, if you're an advertiser, be it on the corporate or the consumer side, you're not looking to add additional dollars at this stage to the likes of an Alphabet or a Meta. So I think they will see a further slowdown. I think it's probably, you've asked about tariffs, and that's kind of, what this is all about. And obviously, there's been a major shock. I mean, the markets were expecting reciprocal tariffs. In other words, if Vietnam charges America a 10% tariff to export its goods to Vietnam, then America would charge a reciprocal tariff of 10%. Yet that's not what was announced by the Trump administration a few days ago. I mean, we think this is a very extreme position. Now, some of those Southeast Asian countries, like a Vietnam, is 46% tariff, and a China is 54%. So, you take a company like a Nike, it's a great USA sporting brand, but, is it going to be able to cope with, this very extreme sort of 50% tariffs, where over 80% of its goods are imported from Southeast Asia, where they're really importing the cheap labor. So we think this is, Trump is a very extreme guy. He puts out very extreme, starting points, and then you use that to negotiate. So, and already over this weekend, we've kind of seen some success on that front. I think over 50 countries have contacted the Trump administration to say, we seek some kind of free and fair trading. And, we're fully cognizant that perhaps, the relationship between these countries and the US has got a bit extended over the years. But, I think markets at the moment, given that there's no sort of movement on this tariff issue, are pricing in recession. And that's where, one's got to do more work on recession versus those companies that are directly impacted by the tariff issue.
Right. And Richard, Gavin, you're on the long-term side. Moving it back to the short-term side, Shaun, there's obviously going to be a lot of volatility over the next number of days and even probably weeks there. From your point of view, what are the first things you look at as far as if you were going to play a market bounce?
So the first thing I'm doing is getting out of positions that I feel won't rebound as quick as some of the bigger ones. So what we found with falls like this is the lower liquidity companies, the ones with lower market caps, usually don't bounce back straight away, and some of them don't bounce back at all. So we've often talked about a market changing from a bull to a bear market and then back to the bull market. Yesterday's heroes in the bull market don't normally correlate into the new ones coming out. So the themes that we will see in the market will probably be a surprise. And the old ones, which did really well, some of them will come back, but most of them, the lower market cap and less illiquid ones, just don't come back. So what I'm doing, I'm selling more of the lower market cap companies and putting them in safer stocks. It's definitely risk off now. Trying to find safer ways of making money, and there's definitely our ways, especially there's quite a few index trackers, for example, and you can trade them on the ASX pretty easily. They're extremely liquid, and They just follow the overall market. So you basically know if the market bounces, you will make money there, and obviously vice versa. It's very, very risky playing them, but I think it's a lot safer than some of the smaller ones that we used to buy and sell.
Right. And Shaun, I want to ask you, as somebody who you generally nobody would even know in a single day, you're not emotional about gains or losses, but what do you do in your portfolio with, unfortunately, those illiquid stocks where you just cannot get out at the moment?
Well, Greg, if they're illiquid, you can't do anything. You just got to watch them and accept that this has happened and try and move on. There's no point selling down. Like, I could sell down some of my positions down 30-40% today just because there's no liquidity. And sure, everything's got a price, but today the price is a lot lower. So yeah, trying to stay tough. I have been through this a few times. I'd say every 3 to 5 years we'll have events like this. And yeah, I mean, I remember in 2008 when we had a very big fall, I stayed away from the screen and just did nothing for a couple of months. Yeah, but I do feel that this hopefully won't be as bad. Sure, there's legitimate reasons behind the fall, but I think if we compare this to COVID, the numbers aren't looking as bad, but COVID was like a worldwide event that affected everyone.
For
I
sure.
don't know if this is going to be as big, but hopefully we get the bounce back. That'd be good.
Yes. Hey, Richard, Shaun mentioned it before about the 2008 timeframe period, and I'm sure you remember that very, very well as well. One sector in particular I wanted to ask you guys about your financial services companies, and I know that you track them well, and those shares have gotten hit particularly hard over the last kind of 2 weeks. Any thoughts about them, especially the big money centers?
Yeah. So we own stocks like JP Morgan and Wells Fargo. I think these companies are incredibly well managed. They're not massively, expensive going into this. They were probably in the low double digits, 12 or 13 types of multiples, and they're now trading on probably 11 times. So, I remember, both Gavin and I were in, remember the GFC well, and, there was really, we came to work not knowing whether banks were going to survive. I just don't think it's that environment. I mean, these banks are going to survive. JP Morgan have got, in excess of 15% tier one capital ratio. The Wells Fargo and Bank of America are sitting in the double-digit tier one capital ratio. So I don't think there's that worry. Is there going to be a slowdown? Absolutely. I mean, is there less, as we can see, there's less IPOs, there's less trading, capital markets activity. In terms of their wealth management businesses, assets have gone down and repriced. The S&P's 20% lower, so they're going to earn 20% lower on those businesses. I think, the other thing safe to say is that they've got no direct tariff exposure. So, Wells Fargo and JP Morgan and Bank of America don't import anything from Southeast Asia or around the world. So it's really a secondary effect that, they're lending to companies that might be impacted. And so, will there be some write-downs of some of their loans, and, will rates, that's the other thing is that, the Federal Reserve has got quite a lot of firepower. Rates are sitting at 4.375% in the USA. If inflation is more or less okay, can they cut rates? Sure, they can. They'll be a little bit hesitant with inflationary shock of tariffs, but the yields are coming lower, oil prices are coming lower, commodity prices are coming lower, and we've seen oil move from over $70 to $60. So I'm giving you a long-winded answer. We think that the banks are well managed, and they're already off 25%, so they're already starting to price in some element of recession. So, and then they're backed by decent, dividend yields as well, and share buybacks.
Right.
Just the last point to make is that if you look at, you listen to Scott Bessent and the Trump administration, the Republican or Trump administration are looking to deregulate a lot of the rules. So this whole Basel III, which had very draconian rules on the banks, I think a lot of that is going to give way to deregulation, which should allow the banks to have more capital to lend, to grow the economy and also to buy back their own shares. I don't know if you've got anything to add.
And yeah, no, that's so. In other words, a lot of these companies, they would potentially come down into that buy type of zone where the multiples really have contracted very, very sharply and very, very quickly.
Exactly. So, I mean, when the sort of Trump came into power, these stocks had quite big moves. Wells Fargo had a gigantic move. We did trim into that strength, but now with stocks, down 25%, we're certainly not sellers of these stocks, and we're going to be adding to these stocks. As I said, they don't have direct tariff exposure. It's more a secondary impact in terms of the impact on corporates and the sort of wider fear of recession.
I mean, Greg, just to add to that, I mean, the selling's just been indiscriminate. I mean,
Yes.
I know, Shaun's talked about from the trading environment, illiquid companies and how hard they've been hit, but certainly across the board, whether it's banks, whether it's big tech, I mean, Meta and Google, those shares are both down, plus minus 30%. There's nothing that hasn't been hit hard here. And there's other, there's other like technology companies that are in the ad tech space on consumer fears. Those shares are down 40-50+%.
Yeah.
So we're seeing that in very smaller caps as well, where certain sectors that aren't affected and actually benefit from this, for example, antimony. Antimony, I think, hit record prices over the weekend because they exempt from tariffs. All antimony stocks are down at least 10%. And I think it's just investors want to rotate their winners into stocks that they hope will perform better. I just got a question for Gavin and Richard. Like, I've been invested in your fund for quite a while. Is there anything you guys are doing, like on the sidelines, just offering investors with a quick opportunity? Because you did mention that you were considering it, but we haven't spoken since. Are you going to open up the fund?
So, yes, I mean, we actually sent out a communication to all our investors yesterday just to give them an update on what's happening in our views. And for our own fund, we actually only price our fund once a month. So applications and redemptions only happen at the end of the month. But in extreme circumstances, we actually take the opportunity to strike a unit price, where we think the market's fallen dramatically, and to actually do a mid-month unit price and allow our investors to invest so we can take advantage. So interestingly, during the significant falls in COVID, we did that twice in March 2020, where we raised additional investments from our investors so that we could invest during that time. And this is the first time we're doing that again since COVID, where we're going to strike a unit price at the end of the close of US market today. Right. And then that'll give us the opportunity to deploy additional funds across the board, across our companies in the portfolio.
Have you got performance based on the last time you opened mid-month? Like what sort of performance returns have you had since then?
Yeah, so I mean, it's hard to give you up-to-date performance because the market just keeps, falling dramatically. But I mean, if you look at the, how badly the market fell, as of the close of the end of March, when our last unit price was calculated, when we hit that mid-month NAV, we're up about 50% from that point in March 2020.
Right,
yep.
That's great.
And that was at a point where the market fell. I think it was like 30% by, I think it was the 18th or 19th of March. I can't remember the exact date.
Okay. I just had a look at the largest single-day decline in rebounds over the last 50 years. And I think that this is actually pretty interesting to see. I mean, obviously, October 87 was the worst here. But when you look at returns on any 1, 3, or 5-year basis, literally every single one of them is positive. And I can assure you, at least in 2008, I was as scared about the market as I'd ever been. So the point is, it really does pay to look at the long term. And not only that, and as another way of looking at, I guess, the reason to stay in the market, if you look here, what this tells you is, on balance, the S&P returns around 10% per year, and I believe the ASX is about the same. But when you look at if you missing out on the top 10 or 20 days, it hurts your returns dramatically. And if you miss out on the top 30 trading days ever, you actually end up losing money. So you go from up 10% to down money. And I think that it's just really important to just have that type of perspective when you're thinking about the markets overall and how ugly and how bad it feels.
Just adding on to that, Greg, and we did mention before, so what do you do? Like, what do you buy?
Yeah.
I wouldn't go buying the micro cap, small cap stocks, as I said before, because a lot of them won't bounce back. It's rather going to those more safer sort of stocks, or there's quite a few index trackers, and that's probably the safest way to do it. So those returns you would have got, obviously, if you bought the market, the index. Specific stocks will move a lot more up or down, or you find a fund like Orsaro and you put your trust into people that have done it for years. So there's many different things to buy, and it's not just about going to buy any stock out there. You've got to be pretty specific, and that we're not saying to everyone go and buy today, because tomorrow could be down as well, and so could Wednesday.
Definitely.
But in percentage terms, we have fallen quite a bit, but there could be more. Hopefully we've seen the bottom, but the famous saying is if you try and pick the bottom, you may end up with a smelly finger. So
exactly. Hey guys, we're just conscious of time, and we definitely want to open it up for Q&A. So if anyone has any questions, feel free to ask them there, or if you're a little bashful, you can always just WhatsApp us. I'm getting a couple right now here. And Richard, I think that this will be for you. In the bank sector here, what are the best banks to pick up at this point in time?
So are you talking about the Australian banks?
I'm just reading a question here.
Yeah.
I'm going to assume it's global banks, just knowing the fellow, but I could be wrong.
Yeah. So, I mean, we can't really comment on the Australian banks because we don't own any. I mean, we know the US banks really well. They're phenomenally managed. Jamie Dimon is a phenomenal leader of JP Morgan. Charlie Scharf is a phenomenal leader at Wells Fargo. We think the returns on equity, the price to books, the PE multiples, the dividend yields, the tier one capital ratios, these banks will weather out the storm. We don't think it's a GFC type event where the banks were going under, or worries about the solvency. I think it's more worries now about recessionary type environmental conditions. And the banks are provisioned for a lot of losses. So we think the US banks are attractive. We like the business models. They're diversified businesses. They're global businesses. We think they're attractive.
Right. Got it. And also another question we're just getting in here is, which ASX companies do you suggest buying here? I guess I'll take that one there. We're not recommending any particular company here. What I will say is that there are plenty of, and Shaun pointed out, Shaun, do you know maybe some index trackers that do trade?
I see the question there from Mark. So the Australian index tracker that I follow is STW. So that pretty much mirrors the All Ordinaries, ASX 200, and you do get a dividend as well. There is one that mirrors the S&P. I think the code is SPY. I'm just not sure how currency plays into that. So obviously do your own research. But the S&P SPDRs, there's quite a few different trackers on the Australian market. There's even a property one. I think the code is SP. No, I've lost it there. But there's a property REIT one as well. So Mark will send you an email later. I'll get all the S&P ones. There's quite a few. Right.
And I'm getting another question here. They're asking it to Shaun, but I'm sure I can ask it for both of you actually, which is how much money what percentage of your capital do you decide to deploy at one time?
That is actually a pretty relevant, we're time to prepare for today, given Friday night to this morning. And I did decide an amount that I would deploy this morning. probably did get sucked into putting a bit more because there feels like so many good opportunities. But yeah, I will day trade quite a bit of these more liquid companies, and we have seen a bit of a bounce this morning. I do know that the market was down. I think it hit almost minus 500. It's down just 300 now. So day trading's a lot safer than holding overnight now. Like if you take a trading punt on tonight, anything can happen. Yeah, so it's really risky. Greg, I've just had a question here.
Yeah.
So yeah, this question is the investor's saying, on 180 markets, how do I know which capital raises to take when the market? So that's a very broad question and something that we try and we want everyone to know that 180 Markets is a do-it-yourself platform. So obviously when the placements come back, there will be a lot of good opportunities. But yeah, speak to an advisor about that because we can't give any advice about that. So yeah, just be very careful. There will be some.
Right.
Yeah.
And Gavin, I wanted to ask you the same question back, which is when you're a fund manager, obviously holding cash can potentially drag returns as well. It can actually help returns in a negative market. But how do you balance out, how much cash to be holding or not holding at any given time?
Yeah, it's a good question. I mean, to Shaun's point, the market feels pretty scary at the moment. The VIX, which is the measure of the fear index, is at levels, similar to the GFC or COVID. And you just don't know how long this would last. So for us, we're just deploying our capital slowly. So, we pretty much have been buying every single night for the last few nights. And generally, we're deploying about 0.5%, maybe 1% of the cash we have available. But we're not going to go in one night and just buy deploy 5% of our cash. We're gonna go pretty slowly, and certainly that's worked okay for us. As we've just seen the market continue to slide, over March and now into April.
Right. Okay. I'm just gonna I'm gonna read this question verbatim. I haven't read it. Hi guys, forgive my outlook. Says what's the question here?
See the question you want to answer, and it just shows how scared people are. So it's, I don't know, Gavin and Richard, if you can see the question too from Dominique, about how this could really affect the whole finance world. And it's, I don't think things are that bad yet, but yeah, I mean, Greg, what do you reckon?
I think that this is the classic, just given the tonnage of your question, it's important to keep in mind that these big sell-offs, they're unusual, but definitely not in uncharted territory. It happens many, many times. In fact, even I believe intra-year, a typical drawdown can be about 13 or 14%. So the speed of it is fast. Trump definitely can bring in a different element to the picture. But the actual market movements, they are not really that unusual, believe it or not.
Greg, can I jump in? I've actually pulled up quite an interesting chart that was actually posted last night, and it talks about the number of corrections since 1940 of certain magnitudes. And there's been 32 corrections of between 10 and 20% since 1940. 20 to 30% corrections, there's been 7, of which, we're now in that range. There's only been 4 corrections of 30 to 40% and 3 corrections of 40% or more. So, with a 20% plus correction now, you're really in kind of a rarefied, level of correction since 1940.
Right.
And every time it just feels as scary as the last one. And every time you panic, and you just got to keep a strong head. And I mean, yeah, it's the same as every boom. Every boom feels awesome, and it feels like it's going to go forever. It never does. And like even just a few weeks ago, taxi drivers, Uber drivers were talking about gold stocks and how you got to buy gold stocks. And Bitcoin before that. It's exactly the same on the way down. Everyone's really scared, and maybe rightly so. But yeah, Gavin and Richard, there is a question about hedging, I think, from the Aussie dollar and tariff-related developments. I don't know if you guys can see the question there.
Can you see the question? Yeah.
No.
It says, how are you positioning the portfolio to hedge or benefit from further tariff-related developments? Have you made any recent allocation changes or looking at concentrating capital in certain sectors?
So look, I mean, currencies are notoriously difficult. We would just say since the Aussie dollar free floated, the long-term average is probably somewhere in the mid-70s. And, you know, every time, I mean, we saw this again in COVID, every time there's one of these crises, there's a flight to kind of safety and, you know, the US dollar. So I think, you know, it was very brief, but for a day or two, you know, in that COVID shock, I think the Aussie dollar got to about 56 cents. We typically, you know, do start hedging the portfolio at these extremes. So we have started hedging the portfolio, and this morning it got down into the high 59s, and we will keep going. And so last time around we kind of had a strategy at every 1 cent we did another X% of the portfolio. Now I think in the GFC, the Aussie dollar might have got to 50 cents. So we say we're not currency expert, but the long-term average is about 75 cents. So when you start getting dislocated from those long-term averages, there'd always be good reason or fear factors. This time it's going to be China. It's going to be heavily hit by, these Trump tariffs, and hence that's our major trading partner with Australia, and hence the Aussie dollar should go lower. We just think, when you start dislocating like this, it's normally the right time to start the hedging process. So that is how we approach it. And I think Shaun was talking about, obviously one can't give advice because we don't know people's circumstances and we're not licensed to give advice, but there are options like an S&P fully hedged instrument.
Yes.
And in our fund, we are certainly starting to hedge the currency exposure.
Right. And one thing's for sure, people, that there's an ETF for any type of strategy that you have these days. There's no lack of them out there. Dominic,
I've got a question in, I'm just reading the 180 inbox. It's another question to Gavin and Richard. You guys said that you are opening up the fund mid-month. Is that available to investors that aren't already invested? And if so, what's the minimum investment amount?
So it is only, because of the short time frame, it is unfortunately only available to our existing investors, because there's an application process where you've got to go through AML and KYC with our external administrator. So we just don't have the time frame to turn that around. So for new investors, we only accept that at the end of a month.
And what's the minimum investment?
And the minimum investment is 100,000. We're a wholesale fund, so that was the other thing I had mentioned. So we can only accept investments from wholesale investors. So at the time of application, any investor would need to get a certificate from their accountant just certifying that they're a wholesale investor.
And Gavin, also just adding to that, if someone wants to invest at the end of the month, which would be April 30th, to give you time to get the AML check and everything done, when's the realistically, should they have everything to you by, say, April 15th or April 20th?
Yeah, that sounds about right. April 15th, April 20th are, if it's an online application form, it can either be accessed from our website or we could send the link to someone. Our external administrator, which is Apex, which is one of the big administrators in Australia, they run the whole process, and they're really generally pretty efficient at getting things done and turned around.
Got it. Now, switching here to Dominic's follow-up question, I'm just going to read it verbatim, guys. I don't think you're answering the question. I asked you about anticipated deregulation that may occur. What type of deregulation will small investors lose protection?
Yeah, so the deregulation I was referring to was one of the sort of Trump administration's goals is to deregulate the financial services sector. So there's been unbelievable amount of gold plating and levels of capital that they've had to hold in the USA. And we think, a lot of that deregulation gets lifted, not only on banks, but also on business across America. In terms of will investors lose protection? Presumably you're referring to that sort of $250,000 protection at a specific bank in the USA. I think it's
I don't
probably
think that.
unlikely that you're going to lose that protection.
Yeah, I would be absolutely stunned, especially after 2008. And
Yeah, I mean, the intention, as Richard's saying, it's really not about taking anything away from individual investors. It's, it's more about making, economies work better. And, the regulations that's been implemented over, the last few regimes, particularly in America, has just slowed, things down. And what the Trump admin's trying to do is to deregulate to allow for a pro-growth economic agenda.
Right. Okay, everybody, I don't see any more questions right now. Shaun, are you getting any more questions directly to yourself?
No, I'm not.
Okay. Well, guys, everybody, thank you so much for joining us on short notice. I think that, in conclusion, panicking has never made anyone a dime. There are not many good things about looking at long time frames, but what you can see is that over pretty much any long time frame, markets do tend to trend higher. And if you have any specific further questions, just let us know. We're here for you always, and thanks so much for your time. Bye.
Thanks, Greg. Appreciate the invite.
Bye-bye.